Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us again as a special guest, Harvey Organ. Thanks for joining us again, Harvey.
Oh, it's my pleasure being with you guys.
Well, we invited Harvey back on another perfect timing here with gold and silver smash today, the day after the April FOMC statement. Silver is down 6%, nearly $1 over the past 24 hours. Gold is down 3%, over $30. Both smashed right through round level resistance with 16 in silver and 1,200 in gold. Silver actually has climbed back above 16 in the afternoon session here. And gold also is about $10 off the lows. But what's your take here on the action today, Harvey? Is it all about options expiration, the FOMC, or both?
Well, actually, this goes on for the last 10, 12 years. And we basically have three sets of options expiry. The first set occurs when the options expire at the COMEX. And that's generally 4 days before first day notice. That's the first set. Then comes the LBMA options, where people have an option to purchase an LBA contract, or it's a private club over in London. And then and that's generally the last day, which is today. And then the third one, which is probably the biggest, is the OTC market between the banks, where they make bets between themselves. And generally speaking, lately, I think I've been seeing this probably the last 15 to 24 months. It's always the last day you've seen precious metals fall dramatically. So the bankers want to be on side against the hedge funds, so they will whack gold on a day like today. And I just knew it. And that's why I always report it. It's going to happen. And don't let it worry you. So that was the name of the game, and nothing really else. The bankers decided that it was necessary to lower the price, and then tomorrow gold will be back up again as we go into May 1st. Okay, this is the crooked game that these guys are playing.
Gold has been really in a range trade the last few weeks of about 1220 on the upside and 1180 on the downside, and it's back within that range here, Eric. As I mentioned, silver's back above 16, but really on the 6-month chart you can see a head and shoulders pattern forming. What's your take here on the more intermediate term, Eric?
First off, I want to say that I think Harvey's explanation is spot on. And despite the carnage that we're seeing here today when we're recording April 30th, Thursday, it's interesting to look at the week in total. Earlier in the week, we actually had a rather significant upside move that was somewhat surprising given the setup that we were leading into with the COMEX options expiration as well as the FOMC meeting. And that made a lot of people stand up to take notice, because that was a violation of the typical cartel rules when it comes to the way they play and the way they roll their game for those other contingencies. And then today, even with this big crash, as you just noted, we're back over 16 for silver. We have seen roughly 1180 as being kind of a sticky zone where at one point it was support for a long time, then we broke it earlier in the year, then now all of a sudden it's support back again, and at the same time we see interest coming into the market and people are buying this dip. And I think all of that speaks to an ongoing growing number of market participants interested in physical demand, and physical demand is what serves as the backstop for this market. And even though China is closed today, if I have that correct, Harvey?
Yes, they are closed, yes.
Even with China closed in particular, it's all the more significant that we are seeing this reasonable bounce back and continued support levels holding. So, there's so much going on in the weeks and months ahead that augur for higher precious metals prices. I've outlined multiple times already on our show what I believe is going to be happening with respect to China's compelling need to declare some elevated level of gold holdings, and I stick and do what I think will be July plus or minus 1 month in terms of when that's going to come. And when that comes, and to remind listeners, or for listeners who haven't heard the previous two shows or other podcasts I've done, I believe that China is going to declare less than 4,000 metric tons, but above whatever Germany has, and I forget what that is off the top of my head, but that would be somewhere, most likely China coming in, and this is my best guess, of 3,800 metric tons, 3,900 metric tons, give or take. That would be sufficient enough to overcome some of the skepticism, for lack of a better way of putting it, when it comes to the renminbi's role and the potential inclusion into the SDR basket, because there are a couple of things that, per traditional IMF standards, China does not currently meet when it comes to meeting the objectives of inclusion in the SDR basket. The currency is now the second most widely used currency in terms of the settlement of trades of goods and services, so by no means is China's renminbi not extensively used, so it meets that qualification for the IMF SDR basket. But they don't have an open capital account. The markets are highly regulated. There's not free flow of investment, and the yuan is still pegged to the dollar in a managed float regime. So I'd also say that it's probable that we're going to see China actually greatly expand the band on that managed float, if not outright remove the pegging this summer, and that will be another possible surprise, I suspect. But at least with respect to the declaration of a higher level of her gold holdings, not all that she holds. I mean, it's in my educated guess as to looking at what numbers have come out of the Shanghai Gold Exchange and the history that Alistair McLeod talked about since 1983 on a going forward basis. I mean, it's darn clear that China has well over 10,000 metric tons of gold, and numbers that even Alistair McLeod kicks out about 20,000 plus are even doable. But that's not what China is going to declare. She's going to declare just enough to be taken seriously, and by extension, the 95% of the managed money around the world that constitutes the majority of money in our financial markets, the dumb money for that matter when it comes to issues of understanding what is really going on in the precious metals market, will get slapped upside the face, and a certain percentage of that money will, and the managers thereof, will move into gold and silver more aggressively over the summer. So I think this is all just noise, and there's just so much going on when it comes to the fundamentals for gold and silver. I frankly believe that the fundamentals are on par with the way they were in 2001 and to start this bull market, given all the things that have changed, the built up in the monetary base for central banks that are destroying their balance sheets, the amount of credit default risk and outright system implosion possibility with a derivatives overhang. I mean, we have the biggest mess on our hands that mankind has ever been able to concoct in financial market history. And the idea that people are going to stay away from gold in particular and silver as an after-chasing effect with even more leverage and ability to perform better than gold is just nonsensical. And I strongly disagree with people like Kerry Dent that are running around with basically the advice for people to ditch their insurance when it comes to having a financially sound, balanced portfolio. So in a nutshell, I think even through the pain that we're seeing this week, we can even see in the trade itself signals that there are a lot of buyers out here that are picking up this dip. They're buying the dip, and a lot of people are very frustrated. I understand it. I feel the same frustration myself. But people own gold and silver for the reason of insurance first and foremost, or at least that should be the single paramount reason for exposure to precious metals, and by no means has there been any kind of diminishment of the risks that justify having that insurance.
Okay. I think it's kind of important to go through what Alistair McLeod wrote, and I think he's bang on, because mainland China I really picked up quite a bit of gold in the area of 1983, let's say, to 1996. So that was an area that we really didn't know much what was going on. And certainly China being a gold lover, I strongly believe that McLeod is correct, that they have actually did pick up 20,000 tons of gold. And it'll be interesting is the reason they're now, that the gold that's coming into China now is not for sovereign China. It is for its citizens. So in other words, they want this. Well, it could, unless if they picked up so much, they want to transfer the wealth to their citizens. And one good way is to let them go. The interesting thing is that China, mainland China, will only purchase gold through it with its dollars, whereas the other purchases will be done through yuan. Okay, so that's how you know. So that's how mainland China, sovereign China, is trying to get rid of its dollars, and will be purchasing gold or assets with the 1.3 trillion of U.S. money that they have accumulated, and that probably lends into the story as to why they want their silver back. Okay, because they knew that gold was being suppressed. They were part of it. They didn't mind, but there had to be an above ground supply of silver. And who was the only sovereign nation that had silver to give? And that would be China. And they probably gave it in probably 2003. They want their silver back. And that's where a lot of the fun is. And that's why I'm confident when I say that through proxies that mainland China is the long position at the COMEX. And they're ready to take position anytime is necessary to take the last 100 million ounces of silver that may be there.
So to play devil's advocate on that position, how would you respond to somebody saying that, well, if China were to try to take 100 million ounces out of the COMEX, that the COMEX would declare force majeure and cash settle?
Probably. But they got the gold already. You're probably right. And we don't know what's moving across there now. We certainly are seeing some amounts of silver leaving the COMEX. I'm not too sure. A lot of the data seems a little fictitious to me, but because I'm seeing entries of 0.000, and supposedly COMEX is supposed to be a physical exchange, physical COMEX. I'm supposed to see odd numbers, and I'm seeing things, and of course in gold I'm seeing nothing but kilobars. It's like 90% of the transactions are kilobars. That's funny because kilobars are an Eastern phenomenon. Like China wants kilobars. What the heck is COMEX doing with kilobars? So I'm a little suspicious as to the actual inventory and what they claim is over there. Of course, the other issue that you guys is Butler's basically says that J.P. Morgan has been accumulating massive amounts of silver and putting it in their vaults, and he says that they have 3 times what the amount that J.P. Morgan claims. Who knows? Does J.P. Morgan know something? Probably they should, but who knows what goes on? We really don't know. They're very, very opaque. The one thing that is clear, very clear, is we have approximately 45 tons of gold moving across, first from London. It can actually start from the States too, but generally it goes from London to Shanghai, to Switzerland, being refined to kilobars, and then over to China. And that's roughly an averaging per week of about 45 tons. That's dramatic. And then we have, we certainly have India. Now they're going at about 1,200 tons a year. Together, both of these guys are about 150% of the amount of gold produced in the world. So somehow some sovereign nation must be supplying this gold to satisfy Russia, satisfy China. And also Russia's picking up probably 30 tons a month too. So the gold has to come from somewhere. Yeah. Now we know that London is now in negative go flow rates now. Okay, we're seeing it in negative Euribor rates, which by definition probably means that gold is not there in London. So if London is short in supplying, who is supplying? And it seems that the gold is probably coming from the Federal Reserve Bank in New York.
Yeah, and we can also see data points like gold exports out of the United States on an annual and monthly basis exceeding mine supply generation. I mean, the amount of gold that's leaving out of the United States that's declared in data sets that aren't manipulated just yet proves that there's got to be central bank dishoarding.
Well, let's look at that. You're right. It's, I think a couple of months ago or last month was $4 billion US dollars worth of gold. Well, remember, you've also got to feed the COMEX, you got to feed the jewelers here, and it certainly lends into the theory that the United States is selling far greater, not selling, is exporting. And the United States has a strange habit of, they claim an export of gold which is not theirs. You'll notice all the time when they say 4 billion and the gold leaves the Federal Reserve Bank of New York, which is foreign held gold, the United States gets credit for which is not true. And they've been doing this for quite a while. It's hedonistic. It's wrong. But of course, that's the data. They somehow take it out in other areas, but the headline is the 4 billion, and all of a sudden, as you're saying, you're scratching your head. Well, where's it going? So, and that will certainly explain why Germany is having real trouble getting its gold back. I mean, it wants its 1,000 tons. I think it's 1,500 tons of gold that it wants back. It's only got about 100 tons or so. It looks like the Federal Reserve Bank in New York is giving about 10 tons a month. Yesterday, I just saw the data. It's about 10 tons. And that's how much gold they can have. Now, the gold at the Federal Reserve Bank is earmarked. Earmarked means it can't be touched. Well, why is New York having trouble giving Germany its gold back?
And even when they do repatriate, so to speak, Dutch gold or what have you, in other examples, there's been no audit of the gold for the Dutch people. They have no idea that the Dutch actually took physical delivery, and the central banks have had a long history of double, triple, quadruple, etc., counting the gold that are on their balance sheets. I mean, they push it out into the market, and they still count it on their books as a gold asset, even though it is encumbered by multiple claims to the same ounces.
Yeah, I think that Holland got their gold back. I think it was real. I think the 122 tons of gold that Holland got was real.
Well, you may be right, but the point is that there was no audit and there's no proof, and that much is not open for debate. That much.
No, there is not. No, Holland is just not telling us.
Yeah, exactly.
Holland is just keeping quiet, and probably because of the airplane that went down. And Holland and the United States probably said to Holland, don't say anything, and now we'll give you your gold back. So they said nothing, and they got their gold back. But everybody else is not getting their gold back.
Very plausible theory.
Okay, there's
but
another.
Ultimately, we don't know because the central bankers are doing what they always do, and that's not disclose anything. And that's really the take-home point. We don't have an audit out of Holland's gold and so forth.
One of the things I asked Coos if the gold got back was the same, or did it had to be remelted and things. So he asked them. He lives right next door to the Central Bank of Holland, and of course they never answered him. they never answered him. Okay, I thought that but we do know that the 5 tons of gold that Germany got back originally had to be refined. It was and we don't know anything else, and Germany is keeping quiet. They got their gold back. We don't know if it's their own gold or if it's new gold. And my bet is that it's new gold. And as it's coming, why it's 7 years it's going to take for Germany to get its gold back.
Or coin melt from the Roosevelt period.
Well, wait a second. Coin melt is not held at the Federal Reserve Bank in New York. Coin melt is held at Fort Knox. Okay, in 1933, all the double eagles and the eagles that were melted were placed in blocks, and the weight was 110% to equal, because there's 90% gold, and that gold moved into Fort Knox in 1937. And all the gold. Now, the only time you could have coin melt move to New York was near 1968, when they had to settle for the London gold pool, and then of course 71, they had to, so any of the, to settle the trades before Nixon just said that's it. So some coin melt may have got there, but it would be small, very, very small amounts. So you certainly, if I saw massive amounts of coin melt moving across from the Federal Reserve Bank of New York, I mean, I'd be suspicious that something is wrong here. Okay, so it means that Fort Knox is out. Okay, so I don't think there's any gold at Fort Knox anyway, but that's another topic. But that's why they're keeping silent about all this business of, you know, who has what gold. I don't even think the IMF gold is real. I think that's double counting. So they claim they have 30. Yeah, they claim they have 3,200. You have to go back in the history, and I think that it was double counted. That this gold really never left the countries. So they just said they had. It's another story, and so when you look at it, you just turn a blind eye to the IMF supposed gold that they have, because I don't think it's any.
Well, Harvey, let's shift topics a little bit here. We really have, as we were kind of chatting before the show, we have two big potential derivatives issues potentially melting down behind the scenes over in Europe. We have Hypo Bank as well as Greece.
And Ukraine.
Right, and in Ukraine, add that as well. What do you think is the bigger risk here, and why?
Oh, I think, well, certainly Greece and Ukraine. I think you would have to weigh them probably equally. See, the real problem in Greece, the total amount of debt out there is approximately 320 billion that's held by the EU and institutions. In 2012, when Greece got their deal, when they were going to go bust, who had most of these bonds, these Greek bonds, were the banks. The Greek bank, the German banks, and the French banks were certainly well up there. And in order to prevent a default, which could have caused derivative mess, then the EU and the ECB swapped these bonds out. Okay, and made a deal, and they changed the covenant of the bonds that the ECB had, so they won't get a haircut. The banks received fresh euros. Now, that's fine as long as there's no default. The problem now is when if once a default goes, they must give these bonds back to these French banks and German banks. Well, what these banks did is they just didn't have these, you know, Greek bonds sitting there idly. They used them as collateral. Not only did they use them as collateral, they used them as tier 1 assets. In other words, it was based on that core holding, they would do their derivative trades and other exotic stuff. And it's the fact that the leverage in the Euro banks is 26-1. And then the actual derivatives, that's another side bet. When you have interest rate swaps and you have credit default swaps, they can go to 100-1. So the mess that a Greek default can give to Europe can be total probably close to $5 trillion. And you got to remember the other thing, which is sitting on the ECB's balance sheet, is the target 2 balances. Now, Greece owes, I believe, about 150 billion euros of that. Okay, so it's that's an added problem. So just one country, which is 2% of the GDP of all of Europe, can cause losses to the banks of close to $5 trillion. And that will bring down the big French banks, the German banks, Deutsche Bank, and they'll all go to smithereens. And that's just one. That's just Greece. And then you got the Ukraine. And then you got the Hypo Bank. So you got 3 big derivative messes on their hand, and they're trying to kick the can down, because if they don't, the game's over. So if you want me to go over the Ukraine problem, I think the key issue there is the Russian bond. That's $3 billion, and the IMF has stated point blank that they want Russia to take a haircut. Russia's not going to take a haircut for that. They're just going to stand there and say, no, I want my money. Okay. Then if if Russia doesn't give a haircut, then the IMF will not give the loans in June to the Ukraine. And that's, well, I believe, what 40, 50 billion euros, something that they need. I mean, that's dramatic. So, I mean, and if Ukraine defaults, again, you have credit default swaps that have to be paid out. You have to be paid, and plus the loans to the various institutions that tried to, Americans, banks that gave. I mean, that could be a real mess. But I think Greece is probably slightly bigger, a slightly bigger mess. And then, of course, the Hypo Bank, which is kept silent, which is a small little bank in Austria, had the province of Carinthia guarantee it. Well, the problem is that the amount of income that the province of Carinthia gives is 1/5 of what the amount they guarantee. So the province goes. Then you have German banks, which also gave. The margins are so thin that they can bring down a lot of German banks and Austrian banks, and maybe even Austria itself. Here's a small little bank that can cause so much problems. So, in essence, those are the three things that I'm concentrating on, because I believe the mess is certainly highlighting there, and I certainly want to concentrate on those. And you can see by the actions of the ECB that they're very, they certainly don't, they need to kick the can down. They can't take a haircut. Nobody can take a haircut on anything. Because the moment you have a default, see, here's the problem. If the ECB has to take a haircut, there's a call on all 19 banks, all 19 central banks. They all got to come up with money. Can you see Italy coming up with money? Slovenia? I mean, they're bust itself. How can they? So that's an issue. That either they kick the can down. There's no way they can allow for haircuts on anything, on any country, on any matter. Anyway, that's my take.
What's your thoughts, Eric?
I think Harvey's is spot on when it comes to Greece, and the haircut issue is kind of like the Achilles heel to the whole chain of possible events that, from the German and European Troika perspectives, is central to the argument. They're stuck. I mean, it's almost like this scenario has a foregone conclusion ahead that it's just a matter of time when we hit the brick wall, but there really isn't any solution other than for Greece to default at this stage, I think, because they can't get any more ability to pay down these loans from their own economy. It's like trying to get blood out of a stone. It's not going to happen. They've already tapped pension funds periodically to make these rolling debt payment schedules, and when you're getting that low, dipping into the reserves of the wealth of your nation, it's the end game unfolding. So, James Turk published an interesting interview with Eric King, I guess about a month ago at this point, where he speculated that the point at which the balance reserves in the Greek banking system falls below the amount due to the ECB and Troika will be the point at which the German and led European institutions will start getting really nervous, because the bail-in would not be able to cover the debt value. And I think that thesis makes a lot of sense. And we're pretty darn close to that trigger just yet. So, it's everyone, even as early as the start of this year, we're looking at the end game being June at the very worst case in terms of can-kicking ability. And I don't see any change in that, analysis, because of just where the monies stand in terms of what Greece can cough up and what Europe needs in terms of their demands. So this is all going to come to a head in the summer. I don't think there's any way around it. And most recently, we've been hearing Greece speak about either doing IOUs as a parallel currency to pay off claims for their pension funds, which in turn they can free up some more additional euros to pay off the Europeans. I mean, this kind of scraping the bottom of the barrel speaks to the fact that there's a solution. and we're going to hit that brick wall. It's a question of when. I don't have the same opinion when it comes to Ukraine because, frankly, $3 billion in the grand scheme of things is something that I think the West will be willing to work around. I mean, Ukraine, without the 50-some-odd billion from the IMF, will crash, and all of the dreams of being able to create a Ukraine that will eventually join the European Union, and all the crazy nonsense of the neocons in particular in the Washington establishment are trying to construct would just go down in flames in total. So, it's not like they're trying to protect the interests of European core Western banks vis-a-vis Greek debt obligations that have these banks in a huge hole. In Ukraine's situation, that $3 billion is like a very small percentage of what would have to be done to rescue Ukraine, and it's on the West's hands now. I mean, we've made a huge mess, and it's not in the interests of the West to see Ukraine completely implode and having Poroshenko pushed down on a rail, tarred and feathered by the neo-Nazi militias that are the core of what remains of the Ukrainian military. And believe me, if they do not get that money from the IMF, Ukraine is going to fall apart faster than you can spit. And these neo-Nazi groups have already demonstrated that they're pretty ticked off by the junta in Kiev, and they don't have the same level of loyalty that they had when the West was promising all kinds of great riches to the oligarchs and to the Ukrainians as far as, post Maidan Square triggering of the coup last year. I mean, the Ukrainians had a certain degree of unity when it came to the forces that Poroshenko was able to put behind him to support this junta that they have in Ukraine. That's all beginning to fall apart. In fact, Minsk II, this peace agreement that was quasi-operative for the last couple of months, was largely put in place because the Donetsk Republic and forces in the east were kicking the snot out of the Ukrainian militias in the east. And the Germans and the French rushed up there independent of the United States' insistence that they stay out of it because they wanted to get a ceasefire, because if they did not secure that ceasefire, it could very well have been that some of the factions of this neo-Nazi militia groups that help support the junta would have turned on the junta and then overthrown and had a new government in place, or just a total anarchy, actually, would be more probable. So anyway, the situation in Ukraine is just so unbelievably volatile that the West is going to buckle. They're going to do whatever it takes to try to salvage the mess, and they're ultimately going to fail. That's the bottom line. But when it comes to this initial $50 billion or so that the IMF is going to dump into Ukraine, I think Harvey and I just have a slightly different take on it. I think they're going to do it because they're going to be forced to do it because they've created such a friggin' mess over there that they're going to try to buy time. And
actually, I agree with you. Actually, we're really on the same point. I think it's such a mess here that once no funds comes in, I mean, they need $45 billion. They have no way to come in. I mean, the neocons are just the Nazis there are just going to overrun, and you can see it. You can see the mess they're in, and the whole country will default. That's basically what I'm saying. I think we all agree. Maybe I didn't say it correctly, but I think we're in agreement there. Okay.
And I even think Putin has an incentive to play nice with $3 billion. I mean, in the grand scheme of things, that's really not a big deal in terms of monetary pain for Russia to absorb. So who knows? I mean,
Putin
may be right, and it'll remain to be seen if he wants to make a big issue out of this. But it is true to say that he's backed down on a lot of other things. So who knows? I mean, I suspect that Putin won't play this as aggressively as you initially suggested. But it may unfold that way too.
Putin's not a very happy camper with the sanctions that's been given. Okay, and he wants it. He's quite angry about it. All right. Look, the Crimea is the sphere of influence of the Crimea is Russia. It's always belonged to them. I mean, what is it of the interest of the United States? It isn't. And really, he's right. Putin is right. And all of a sudden you've got tremendous sanctions and all this fight against them, and I think it's wrong. And yet I think Putin has been a wonderful statesman. I think he's played himself great. I don't think he has infiltrated any part of Ukraine, even though you're seeing the Ukrainians say there's been an infiltration by the Russians, and I don't think they have. I think Putin's been pretty good about it, but he wants those sanctions ends. He really does. So I beg to do a little differently on the $3 billion. He wants that money. Anyway, let's see how it plays out. Anyway, June we're certainly going to know. We got another month to go, and that's when the fun begins in the Ukraine, and then we'll see how the monies that are owed, if they aren't paid, then you have defaults. The banking system will default. The hryvnia will probably blow up. It'll be, and you'll certainly see some banking defaults. Guys that have lent money to the Ukraine will certainly go. Anyway.
I'd love your take on this, Harvey, because I think you'll find this observation pretty amusing as well. There's a growing number of people in the alternative asset community, the precious metals community, et cetera, that are starting to, target September, October as the shit hitting the fan window. It's always, I always find it kind of uncomfortable when a consensus is forming, because I love being a contrarian. And from, early as November of this last year, I was thinking that June through September or July, that the core being June and July, when that window approaches, we see things like Greece possibly fall apart, and it looks like that time frame is in fact going to be accurate. I suspect we're going to see something that's kind of like a barbell. An initial burst of just unbelievable turmoil in the markets coming in June, July, August, somewhere in that time frame, and then a QE launch worldwide, including China, and the Fed backing off on this, we're going to have to raise interest rates to secure our credibility bullshit. And then, maybe some restoration of confidence because of that enormous QE. And then on top of everything else, the second wave of just, the downturn coming next year, first quarter even. What do you think about that? I mean, I find it a little disconcerting that a huge percentage of the precious metals community, alternative asset community, is now all of a sudden kind of singing Kumbaya when it comes to the month of October.
Okay, can I give you my thoughts on this one? Because it's
absolutely, please.
The moment you see China going to QE, that's the signal that you're going to see gold going through the roof.
Yeah, I agree with that.
There's nothing that's the signal. You don't need anything else. Because China has been basically going along with this paper game. And when they realize that this paper game cannot go any further, you'll probably see at that particular point that China then goes to the for their SDR business with the IMF and state how much gold they have. I don't know if you know this, but they actually want to. The Chinese want to include gold as well as a currency.
You're right.
So they just don't want the Chinese yuan in there as well. They want it as gold, and of course, as you stated correctly, they will then immediately float their currency. And then all of a sudden they're going to look. And the other thing they're going to try to do, once they do that, they're going to say, guys, we want an independent audit on everybody's gold. Because it knows, and the reason being, it knows how much gold it got. Very obviously, it knows it can look and count how much gold it's got. And let's say they do have 10,000 tons. And they're going to look and say, well, they can do the math. They got 10,000 tons. It probably came from the U.S., so therefore they got zero. So they're going to ask for an audit. Of course, the United States are going to say, we can't give you an audit. And all of a sudden, you're going to see a real mess. And all of a sudden, the world's going to realize and say, what the heck's going on? And then you're going to see just everybody trying to get gold coins, go into gold, go into silver, whatever they can. And they're going to find there's very little left physical. So that you're going to see a lot of calling in of their contracts. They're no longer going to be called. They're just going to try to take physical metal wherever they can. And you're going to probably see a few defaults by the banks, which they will not be able to deliver upon the contracts that they have. So anyway, that's what I see. The moment China goes into its QE, that is the signal that you guys, you grab as much metal as you can because it's over.
Yeah,
so that's my take.
They'll definitely announce gold holdings before the final negotiations around the table for SDR inclusion, because they need that to be able to be taken seriously, and boosting the credibility of the yuan. Just to play devil's advocate on what you just outlined, I suspect that there's a huge incentive for China to actually not demand an audit, and here's why. They're playing a long game. They're interested in having the SDR basket inclusion as one step along the road to ultimately China having world reserve currency status greater than the United States dollar. I mean, the dollar will always, whatever, even if we have a replacement of a reserve of currency resets and new forms of dollars and whatnot. I mean, the dollar, whatever it is in its form, say 10 years from now, will still have reserve usage in central banks, so it's not going to completely go away. But China's long-term game is to be the largest reserve currency status, and initially they're not seeking to be the sole currency dominator of the world, but they want longer term to be king of the hill. And in order to get there, it's really not in their interest to try to crash the Western banking system. And it's prima facie evidence, clearly the case that they've got some kind of agreement with the United States Treasury going on where they're able to take all of this gold from Western central banks and the West looking the other way. I mean, theoretically, the West could have 2 years ago or whatever point in time did a currency reset and change the rules of the game and revalued gold to float balance sheets of central banks in the Western countries up higher to support the ability to stand against the level of debts that each nation has and so forth. I mean, that was an option, and it never was executed for whatever reason, but instead we've had this kind of brinksmanship going on, and this apparent agreement with China to try to raise their gold holdings so that they can participate in some future reorganized world order from a monetary front. So there's a certain level of coordination going on with China and the Western interests. It's hard to define exactly what that is. In the rearview mirror, 20 years from now, we'll know. But it's clear that something is going on there. So I suspect that it's not likely that they're going to try to crash the system. And ultimately, if they were to demand an audit, that, as you point out, that would probably crash the system.
That's exactly. In other words, what I'm actually saying is China takes over as the reserve currency of the world.
Yeah.
Remember, China knows how much gold it has, and it knows that that U.S. has no gold. It has the gold, and yet it's controlling things. And China says, "Well, wait a minute. I want my say," and if the United States is not giving it, that's an issue. Remember, you got the problem with Japan now with the Senkaku Islands. All of a sudden, you're seeing United States backing Japan entirely in this issue and saying they're coming in to support Japan for these islands. Of course, China's not very happy with this in the South. They think in history it belongs to them. During the war, it was always there. So it's a real issue here. And I think China is going to probably take control more and saying, that's it, guys. This Western business of paper fiat is just not for us. And that's when they will then say how much gold they have and tell the world, this is it. And now let's do an audit. This is what I got, boys. What do you got? Okay. And that should cause a lot of problems for the U.S.
Sure shaping up to be an interesting summer, to say the least.
Yes, for sure.
We haven't even touched on the Middle East. I mean, the Middle East is a basket case right now, too. I mean, what Saudi Arabia is trying to do in Yemen is going to completely fail. The Saudi Arabian government in and of itself is completely illegitimate in the eyes of a great many of the Saudi citizenry. The only reason why the Saudi citizenry don't care as much enough to try to do a revolt is they're bought off. But the ability for the Saudi regime to buy off its population is a lot weaker now. And, what's going on in Syria is pretty unstable to the point where even it's possible that the Assad regime may fall. There's a lot more speculation about that in the background intelligence community and think tank community, where people are talking about how Assad is weakening. I don't actually think that the Assad regime is going to fall, unless if there are introduction of boots on the ground by United States or NATO forces. But even that is a possibility. I mean, who the heck knows how aggressive the West is going to be willing to be in Syria? But the bottom line is that even if the status quo type of power dynamics that exist now continue on through the summer, all it means is that there's a possibility of extended escalation regardless, because of the dynamics that are going on when it comes to ISIS expanding its control, and the friction that's going on with Iran and the United States on different fields and so forth. So I mean, the kind of background fundamentals for gold are more profound now than any other time in this entire bull market, as I noted before. I mean, from a geopolitical front, from a financial markets instability front, from a default risk at sovereign nations level, I mean, to the risk of central banks going absolutely bonkers when any of these kind of problems spill over and they feel the necessity of launching QE at the level that is a magnitude greater than what we've already seen. This is no time to be looking at the trading action we see today and fretting over it. I mean, in the grand scheme of things, the insurance value of gold and silver, I have to reiterate, are more valuable now than ever before.
I think that'll be a great place to wrap the show this week, guys. I guess we can give the listeners just a quick update on the physical markets here in the U.S. Supplies are beginning to tighten, at least in silver anyways. We're seeing the first signs in Silver Eagles. The authorized dealers are running out of coins and warning that premiums will be rising shortly. And the U.S. Mint has not been producing as many coins as they had been earlier in the year and as expected. So we'll keep our eyes on Silver Eagles as perhaps the early indicator that
about 90%.
90% hasn't moved too far. Still well above what has been in recent years, but really hasn't changed too much over the last couple of weeks. So, it's for new listeners, we always advise that 90% is one of the first, is typically anyways been one of the first early leading indicators of supply shortage, as premiums seem to spike quite a bit first in 90% silver, mainly due to the fact that it's no longer produced and hasn't been since the early 1960s. So early reports right now, boots on the ground, are Silver Eagles are becoming scarce. So we'll see how that plays out over the next coming weeks here, with silver down 5% here on Thursday the 30th. So Harvey, before we let you go, if you could let listeners know where they can find your excellent work.
Okay, I'm at www.harveyorganblog.com. Very simple.
All right. Thanks for joining us once again, Harvey. It was great to have you back.
Anytime, guys. Bye. Take care.
All right. For the Doc and Eric Dubin, and then our guest, Harvey Organ, thanks for tuning in to this week's SD Weekly Metals and Markets.